course, we can slice the regional economy in different ways. Of course, we can always see it from a household perspective, in terms of different kind of micro simulation view of the economy. We can take different views of it. But what I've done today is come back to the good old hardcore neoclassical economic view of the world, which is, you know, supply, demand, prices, labour, capital, these kind of things. So in a way, while it's quite a dry kind of perspective on the regional economy, it is, of course, the language of discourse on a daily basis, be it in the papers, on the ABC commentary, in terms of what the monetary policy is talking about. And so, you know, every now and then, even though over time we will be taking a different perspective on the regional economy from the Foundation's point of view, we will be touching base on this because it is still, as I say, the common language. So, the other thing I was thinking about today when I was preparing the presentation and preparing the publication was that, you know, the themes are still coming up. You know, if we're talking about really where the economy is going from and how it's potentially evolving and the issues that it's at bear, fundamentally those, if we're getting it broadly right, they don't change overnight. They evolve and they progress. So hence the part two. We sort of, you know, I presented the challenge of transition before a while ago, so I was having a look back to see what we presented before. And the issue obviously was there, and we've been raising it before, but what we've got now and what I'm presenting to you now is really an update on that, hence the part two. How are we progressing into the transition, and where does it look like we're going to go from here? So, the results, the conclusion, I always like to give you the summary and then try and justify it if I can as we go through it. So fundamentally, we're still treading a bit of a tightrope as we walk from the strength of the resources sector and the huge stimulus that we had coming from that sector across to new drivers, whatever they may be, those that were kept, managed and controlled for a long time whilst we had the resources boom. The labour market, this is the last tightrope, dodgy analogy I'll make, of course, but the labour market is wobbling. You know, if you look at the headline figures, it's looking pretty strong, but really, you know, we think we're heading into a period of weakness. The resources context obviously is changing quite fundamentally. We're progressing through that cycle. So what we will be seeing, of course, is high volumes coming through. Inevitably, but what we're seeing is reduced stimulus because the capex phase is passing, and fundamentally the consolidation, which many of you in the room will be going through in terms of the line-by-line cost review of the mines, etc., is reducing the stimulus that we're going to be getting out, benefiting out of the mining sector. Other business investment, it's really a question of timing, and this is the challenge that we have. You know, we're heading into a serious short-run hangover, and we've got some quite dramatic data in that respect from the resources cycle, not so much in terms of the resources sector itself, but the industries that have been relating to it and feeding into it. And the medium-term potential is there, but it's a question of timing of how that feeds into it from a business investment point of view. Likewise with consumption, the same issues are there, but the balance is shifting a little bit, and the retail sector is a bit imbalanced about this direction at this point. Housing, is that going to come to the rescue? Again, same over time, but again we have a transition issue, I think, there, and I think we're probably going to go into a slightly weaker period because it's been quite strong recently before the strength starts coming through. So on balance, what I think we're looking at is quite a difficult transition through the next 12 months, and timing of when the strength comes up and when the weakness falls away, when the softer parts really fall away, is going to be critical for this. And of course, a lot of this is dictated by the national story and national policy settings, which we don't have control. Michael will give you more insight on that, obviously. But it isn't necessarily going to be designed to suit us. It will be designed to suit the national story and how we fit and how our regional economy tracks through that. We'll have to watch and see. The medium-term outlook, though, is still optimistic. I mean, there's still a lot to be positive about, particularly coming out of a massive commodity boom like we are, and being in good shape. Usually, historically, we'll come out of a boom like that and be an absolute disaster because we've got overheated and be in a huge mess by now. But having said that, it's still a huge boom that's been to our benefit, and whatever we come out to in the medium term is going to be a more subdued version of that. So, usual structure for me. We get some good data from the employment sector, we get a feel for how the general regional economy is tracking. Then we'll look at it in terms of, these are demand expenditure components of the regional economy, and break it down to business investment, household consumption and housing investment, and then wrap that up into the outlook. So employment, this is total employment, and if you look at the headline data, everything looks really quite swimming. You know, total employment in terms of full and part-time employment increased by about 4% over the last 12 months. And the unemployment rate's about 5%, 5.1%. If you look at that and think, well, you know, that's pretty good, what's wrong with that? Good times. But if you look at the details of where things are going, I think it's not showing such a good picture going forward. Total employment, if you look at that, it's just starting to top out. sorry to give you a chart like this first thing in the morning, but the unemployment rate is 5.1 in terms of its official figure. But if you look at the bands there, those are the actual confidence. That figure comes from a sample survey that the ABS does of the region. And what that means is you have to understand that 5.1 is a good estimate, but it's an estimate that could be 1.7% higher or 1.7% lower 95 out of 100 times from a sample survey point of view. So really the real unemployment rate lies somewhere within that band. And so really you can't read last month, a couple of weeks ago if I'd have been presenting this, the unemployment rate would have been 7.1%. Would have been, oh, what's going wrong, it's all terrible. Now it's 5.1. The reality is you just have to see through these jumps of the data that we get. You can see, for example, there in time, that was the GFC, so you can see the unemployment rate is stepping up in reaction to the GFC. You can see it improving over time as the GFC stimulus really kicked in, the resources cycle and the CapEx kicked in again, and we got really very tight in terms of the unemployment rate for a period there. Now we can generally see, from that point on, the unemployment rate in the labour market has been slowly softening. And that's what you can sort of really read from the unemployment data. But it's not just that data, it's other data as well. We measure the hours worked from our survey, our quarterly surveys, there are people's estimation of hours worked, and we can see that that data has turned, and the number of hours that workers' unemployment rate and total employment doesn't account for under and over employment in the market. Hours worked does, and so we can see that falling away a little bit. We can also see people's intention to hire, and their recent hiring practices are really very soft. And that adds also to the job ads data that you've got in the presentation here. So this is from the Newcastle Herald, so it's newspapers. And it's reasonably predictable in terms of a leading indicator of where the job market is going. As you can see, for a few months now we're getting figures that are weaker than the global financial crisis fundamentally. Now it doesn't say it's going to be quite that bad, but it shows really that the labour market is looking weaker than the headline figures would definitely suggest. So let's try and break this down in terms of the drivers of what's, labour market typically lags what's going on a little bit. So let's have a look at the drivers in the regional economy and see what's shaping activity. The resources sector, of course, our friend, the resources sector. Now this is a chart I put up a couple of years ago from our friends at HVRF, who are now at HVRF. And these guys are really pretty good. I mean, we think of them as pretty solid in terms of the quality of their research. As you can see here, this is an estimation of thermal coal prices in terms of contract prices going forward, and they thought it was going to be falling away with the supply cycle, etc. But they didn't think it was going to be collapsing, etc., particularly post the GFC recovery. If we have a look at where spot prices are now, spot prices are not contract prices, but when they're consistently as the learning that you're in the resources sector will know in the rooms that, if they hold around that spot prices over time, they will over time be reflected in contract prices, and that's where we're at. So fundamentally, the fall away and the transformation of the resources sector has happened much more rapidly than generally was being anticipated. And this, of course, is like any rational business, has compelled the resources sector to react in the region of the coal mining industry. We look at our investment monitor of the different projects that are going on in the resource-related sector. Obviously, we've still got Warkworth and those to be determined, those that are in the course for various different reasons, but quite a lot has been deferred. And this is really, I'm not even putting those that got up to pre-approval, so there's a whole lot of wave of them there that were just sitting in the pre-approval phase. But quite a lot, of course, have been topped out because you can't, obviously you can't justify investing huge amounts of capital when the spot price is down to about $80 a tonne or slightly lower. It's a different equation, obviously, when it's $120 a tonne. So this is the cyclical evolution that the coal guys have been dealing with, and of course that means that the CapEx side of the equation has been truncated. Doesn't mean to say that we haven't had a huge amount of activity and stimulation come through, but at the same time, from an economic point of view, more and more of that is being completed. So we're seeing quite a lot of the projects being completed, be they logistic rail work or the actual mines expansions themselves. But the other side is that still some of it's happening. Some of the expansion is still happening. So we still have a bit of a fat tail going through here of resources expansion on the CapEx side. Now, some of that I assume, because the moving feast, this one, very much so, is being truncated, and where they can wisely pull back some of the CapEx that they're planning to invest, and they will be doing so. But the point is that we still have some activity coming through, but we're progressing through the resources cycle. The next phase of CapEx is probably not going to happen unless it's just a progressive evolution of a mine, for example. It's inevitably going to happen. But we still have some activity going on. If we look at the other non-resource investments within the region, from our monitor in terms of the major stuff. There is work on the horizon there, and work that's happening, be it the NBN or be it the university's initiative in the city and the law courts and these kind of things. There's the work around Williamtown, etc. So construction's commenced on those things, but there's a couple of points here. One, most of that is public investment. Now, I had a journalist yesterday ask me, well, is that a bad thing, that we're becoming reliant on the government now? And it would be if it was perennially the case, but in reality, this is a cyclical kind of evolution. The extent to which this public investment either has to happen, in terms of the Newcastle law course, for example, in terms of a replacement point of view, or if it's investment that, from a public point of view, that generates private opportunities down the track for the private sector to come in, then it's a good thing, really, in terms of this phase. And particularly whilst we're going through a downturn or a waning of other capital investment initiatives, is a positive thing. We do have a couple of other private ones there. Likewise with Orica, Orica are having their financial challenges at the moment, so the extent to which they can have a free hand to invest in capital will potentially risk the timing of these kind of projects. So the other point is that they're also smaller. So these things will happen, and they are coming through, some of them. But fundamentally, the resources cycle we've had, the scale of the investment that we're talking about from the resources cycle is so huge, it's phenomenally huge. When we started doing our investment monitoring, we used to monitor anything that was reported in the press. And so we used to get, $200,000 here, a new retail thing there of 500,000. We've had a lot of kind of small stuff, but in reality, you're talking about, as opposed to, $500 million in a new mine expansion or a logistics expansion, huge kind of scale stuff. As we come off that phase, the nature of what we're going to get from a business investment point of view, be it public or, and there's some quite big stuff in here, obviously, with the Newcastle Rail Exchange, for example, and that kind of work, it's hundreds of millions of dollars potentially, but it's not of the magnitude of the resources being. And the other thing is that it doesn't happen overnight as well. So the resources thing, if you want to make it happen, it's going to happen, and you put it in the field, and it'll happen over 2-3 years, whatever the timing was, they get delayed with the capacity crunch. But it still happened. Whereas if you think of something like the Williamtown Aerospace Centre, for example, which is the private development of land to enable any kind of investment that may happen in defence that needs private sector to support it, so there's that capacity built and they're ready for it to go. That will happen as it comes through. Likewise, we're saying about the Hunter Street Mall redevelopment. That is somewhat dependent on demand coming through. They're not just going to build it and hope that demand fills the buildings up over time. There will be, the apartments there will be sold off the plan, and it will be takeover. So it will dribble through the economy more over a longer time frame than the resources sector. Likewise, if you look at what's happening in terms of private, this is non-residential building approval, so it gives you a feel for what's happening in the construction side of retail and office and industrial, and it's pretty flat really right now. Most of the activity we've been happening is more in private capital and the resources side, which isn't accounted for in here. But there's no activity there at the moment. And so whilst public investment will create that opportunity and potentially step this up over time, right now it's pretty flat. But as I say, it's all about the timing. So it will happen in due course, and these opportunities are being created. But right now, there's not a lot of strength or activity being generated from that source. So how, in this context, is regional business faring? I mean, regional business in this respect does reflect the things we're going to touch on in the future in terms of the retail sector, the consumption side, and housing as well. But generally, given this transition that we're talking about from business investment, how's the business sector reacting and faring? Not well, is the answer. This is one of the reasons why I'm really cautious about the transition we're going through and raising it as an issue for you. In terms of our estimations of business performance, this is much weaker than we was. The weakest figure we've ever had in 26 years. And it's not just one either. You look at forward orders over the last 6 months, similar story. Weakest we've had in over 26 years. And this is the same, I'm not going to put them all up here, but for about 7-8 of our indicators, they're exceptionally weak. Business profits, similar kind of story. So we've got record lows in quite a few indicators, not all of them. I mean, if we look at business expectations for the Hunter economy, where they're looking a bit more forward and they're not just looking about how their own practices are faring. It's soft, yeah, it's very soft, but it's not as bad as the global financial crisis, and it's not. So people are sort of optimistic about where we could go, but right now, in terms of their assessment of where how they're travelling, it's really very weak. So people are struggling through this transition right now. They can see where they've lost the business in terms of the transition we come from, but they can't see where the new upside is coming from right now. Or it's definitely not hitting that business right now. A good example I thought of this was in terms of accommodation takings. I mean, the logic is with accommodation is that this is one of the things, the dollar of course has dropped, and Michael will give us a lot more kind of currency insight in a bit, I'm sure. So the dollar's come right away, and one of the theories of course is that, we've all been going overseas because the dollar was so good against the US or against whatever currency where we wanted some holiday. And so, in theory, what that would mean is that fewer Australians will go overseas. In theory, we'll decide to stay locally, we'll spend more of our money, more Sydney people will come to the Hunter Valley, for example, instead of going over to Bali or somewhere else. And likewise, international tourists will start coming back in greater numbers, logically, from an economic theory point of view. This will happen, and we would expect it to happen. But if you look at accommodation takings, they've really fallen away quite dramatically. Now, accommodation takings actually increased by about 58% over the last, I'll get a period for that, but over the last 6 years, I think it is. So they've really been going through a boom. The boom, of course, is resource related. I mean, as you all know, if you try to get accommodation up in the valley at certain times over the past few years, it's been virtually impossible because all the contractors have been filling up the hotels, etc., and the accommodation available. So they've been really riding that boom and making a wave. Making most of it, and credit to them. But of course now the contractors have all gone home, the capex wave is coming to an end, and so that's creating a hole, and this is where that decline is being registered there. So whilst the tourism side of the activity will be picking up in the medium term, and the logic of the currency, etc., will, I'm sure, pay over time, in the short term we've got this hangover from the resources side of the equation. It'll take a while for that medium term benefit to come up from the changing currency context in that respect. You can bring that analogy likewise to other sectors as well. So manufacturing, I'll touch on housing and how this affects housing as well in a bit. But if you think of manufacturing, we were performing really quite strongly for a while as our manufacturing industry fed into resources boom, in particular the capex side of that equation. Now that is falling away, where could they turn, particularly where the dollar was where it was at, and they're competing against very cheap imports because of the currency situation. Now the currency situation is working back in their favour, either in terms of them being able to compete and export or compete against imported goods. But it doesn't transform, it doesn't create a major new market from overnight. So housing, for example, is a potential market that will build up over time that the manufacturers can start feeding back into again, but that's not going to happen overnight. So there's a few illustrations of this hole that we're in the middle in terms of making this transition. Household consumption. This is one of the areas where we really lack data, and we struggle to go and get some good data. But one of the areas we do is from our survey, our HVRF survey of business household. In terms of people's assessment of financial circumstances, it's not as dire as the business one. So people are tracking on okay, and we know that people have been redressing. One of the things that said, we wasted the boom, the resources boom. One of the things that we clearly haven't wasted it on is the payback of household balance sheets and corporate balance sheets for that matter. I'm sure Michael will probably touch on that, but in terms of household balance sheets, we've been paying off that debt that we racked up through the late 90s, early 2000s, and redressing that, not to the extent which we're back where we were in the early 90s, but we're definitely back in a better position, which will improve our capacity to spend going forward. Likewise, people's estimates of spending has been reasonably flat. So the household sector has the capacity to spend. But on the other side of the equation, sentiment is one thing and capacity is one thing. The number of people that are actually going out there and doing it, both from a volume point of view and actual behaviour point of view, is not the same. So if you look at new passenger vehicle registration, which is an illustration of car sales, you can see how we've been through the boom there. And I put the upper Hunter there because obviously that's been exaggerated. And of course with the capex side of things slowing down up there, you can see that they're ahead of the game in terms of their retracting that. They were going through great times up there. And now that's retreating. If you look at that pattern there, you'll see it mirrored there in terms of consumer confidence. So our estimations of consumer confidence, it's consistent with the sales profile there. So consumer confidence is very consistent with retail sales and retail activity. And if we look at our latest figure in terms of that, it's not disastrous in the same way the business one is, but it's still soft. It's really just pretty plain soft. So from a retail point of view, it's not one of the things that's really contributing to an upturn in housing consumption. So if we have a look at retail, for example, let's say, okay, well, the influences we've been talking about before are there, but they're shuffling around a little bit in terms of the positive or negative influence on actual behaviour within the region. So yes, as I say, we've got stronger household balance sheets, so that's people's capacity to go out there and spend is improved. We've got low interest rates, and Michael will talk about whether there's capacity for further cuts to try and stimulate this activity. And of course, if we're spending less money on holidays, we're also taking less money overseas and spending it offshore. So that will be bringing more retail expenditure back into the region. Negatives, you know, if employment in the labour market is coming off, that does take wages and incomes and salaries out of the region, and that takes it out of the retail sector. Soft consumer sentiment, there's a clear relationship with rates of retail there, and that means that that's not contributing. And the fundamental that isn't going to change for traditional formats is that the structural shift to online is, you know, that's not a recessionary thing or a cyclical thing, that is a structural transition that isn't going to go away. So the industry, I was having a conversation a couple of weeks ago with a guy who owned a motorcycle dealership, which you'd think wouldn't necessarily be the most obvious one for being affected by this, but he was saying how dramatically even businesses like that, it's not like people go and buy a motorcycle offline as opposed to going and buying one there from his dealership. But what he's found is that the price margin that they used to have, people have instant information about the price of everything everywhere, and so when he comes in and have a deal straight away, he has to cut his margin. So fundamentally, he's had to cut his margin right down. And the basics of economics will tell you that these guys will survive for a period. They think it's a slowdown and now, but fundamentally they'll have to consolidate on the supply side, and that will increase the margin that's available to them over time, and that will get them more on a sustainable footing. But right now they're still going through that crunch, and so from a retail point of view that's a challenge. So we've got these mixed balances. It's not going to boom, but really the RBA is one of the critical parts here if they decide to really push this, but we'll see whether that happens over the next year. So housing, I just wanted again to give a bit more detail on housing, because it's one of the things where we're looking at, you know, is this going to drive the regional economy going forward? There's quite a lot of story based on that. This is, the black line there is median prices for established median houses in the region. And when I say the region here, I'm talking about Metropolitan Newcastle. It's a new term. I've had to change that. We used to call it the Lower Hunter, which is the 5 LGAs in the Lower Hunter. The ABS now is, with their new categories, there's a new area called the Lower Hunter, which is actually the Lower Upper Hunter, as far as we would know it. So I'm calling this Metropolitan Newcastle to avoid the confusion. So that's the 5 LGAs in the Lower Hunter, as we would know. The red columns there are sales volumes, and the, as I said, the black line is median prices. So median prices stepped up by about 4.5%. You know, it's not as dramatic as it's happening elsewhere around the country, where prices are stepping up a little bit. Is there a bit of sign of life? No, yes, but if you look at sales volumes, they're down by about 10%. You know, it's not, you know, particularly spectacular in terms of saying that, yes, the housing market's taking off. Still very tentative. We look at the distribution of this, and when we'll release the residential market outlook next week, and that's we'll have this chart next year, we'll be able to look at it in a bit more detail. This is just median prices by suburb, change in median price over 12 months to March compared to 12 months prior. Don't look at an individual suburb, because obviously from a suburb point of view, the stock can change quite dramatically within the suburbs, and therefore you could get a 40% increase in your suburb, think it's going crazy, but in reality it's just the stock that's changing. You need to be just looking at the general picture. And the general picture is just, the point I get out of that is that it's just a bit of a mess. It's just a bit all over the place. The strong areas are really the dark greys in that respect, and the weak areas, and some of them are quite negative, is the pale greys. And fundamentally, we know, for example, that Nelson Bay and that kind of area is struggling at the moment. But really, when we did this work last time, we could see the real strength happening in housing demand in the Upper Valley, off the back of the resources cycle. And we could see the strength in inner city Newcastle, where the professional services were feeding into that boom. Whereas what I think we're seeing now is really the transition. It's just a bit of a mess. We've got a bit of a lag of activity going on related to in the upper end. We've got stuff happening in the middle, and we've got, you know, bits and pieces down here. So it's a reflection of the transition that fundamentally going through. The one thing that we do know, for example, is that the boom in the upper hunter has really transformed the equation. So where Singleton, for example, used to be, I forget the precise number, but it'll be in the residential market outlook, it used to be about 75% of the median value of Lake Macquarie. Now it's about 112%, I think, something like that. So we've had a huge shift in terms of the relative values of these things. Muswellbrook, likewise, used to be about 50% of Lake Macquarie's median value. Now it's about 83%. So we've had a huge step up of the relative value of that. But what that means is that as the cycle swings, we're going to see less growth in the upper hunter from the prices point of view, and the activity is going to orientate back to the metropolitan area. When we have a look at buyer sentiment, in terms of housing, we ask people whether it's a good time to buy a dwelling on a quarterly basis. And generally people are quite supportive, so that, you know, more than 50%, close to 60% think now is the time to get into the market. It's fallen away a little bit, but that's just really a sample survey of volatility. Still quite supportive. when I start looking at the critical sectors, first-time buyers are really critical for the housing sector because they're the people that enter the market, being established or new, and therefore drive general new activity, and therefore be it in the established market, they can potentially over time spill into the new market and drive new housing construction. If you look at the figures there for first-time buyers, statistically from a sample survey point of view, they're no different from everybody else. We can't say they're stronger. That contrasts a little bit with the period during the GFC stimulus, where we had massive interest rate cuts, a lot of grants, etc. for first-time buyers, and we know that they really did come out of their shell and get into the market and started driving the housing market regionally. We're not in that position yet at the moment. So that, that's a concern in terms of the speed in which the housing market will really kick on. Likewise, when we look at housing affordability, this is our benchmark of housing affordability for first-time buyers in the region. It's just basically a ratio between the trend in incomes and people's capacity to buy relative to the cost of buying a medium-priced house if you're a first-time buyer. So it accounts for mortgage rates, it accounts for median prices, it accounts for grants, stamp duty exemptions, all those kind of things. And as you can see, it's getting better. It's been progressively getting better, but it hasn't. It's not really in a position that's really, really supportive of a rapid upturn in the housing market. Investors. When I was looking back at the old chart, investors are another critical one because they obviously can enter or leave a market and therefore can help drive it forward. This chart gives you an illustration of something I did a couple of years ago, which was rental bonds, which is an illustration of volume of new stock coming into the market. So the change in rental bonds is your blue columns there. And the black line is outstanding loans for investment housing, so that's how much is being lent into the market. The black line is actually on national data. And the correlation between these two is incredibly tight in this phase where last did this work. It really was a very strong relationship. And there's a lesson here for any young modelers in the region. In terms of what that suggested at the time was that really the investment behaviour in the region was being dictated by national stories. So generally investors thought nationally it's a good time for getting to the market because shares were expensive or interest rates were low or housing had a positive vibe about it. They got into the market and vice versa, and we just reacted accordingly with the rest of the country. But if you look at what's happened over the past 2 years, pretty much since I last did this, that relationship has really broken down. And you can see how we've had a huge volume of new bonds come into the market in the metropolitan Newcastle area, and that hasn't correlated at all with the loans that have generally been put out there. And why is that? Well, it's not rocket science, is it? I mean, it's because of the resources cycle, and because of the strength of employment, because of the strength of demand for tenancies in that part of the world. Investors have bought into that, and have fundamentally helped supply a lot of stock in the region, and demand for investors has come through quite strongly. We look at the total bonds and where they are within the region. Cessnock over the last 2 years has increased by about 7%, and Maitland by about 6.6%. Just an illustration of where it has been. We don't, unfortunately, because of the change of geography, I can't give you the numbers for the upper Hunter. But fundamentally, investors have been buying into the resources, buying the stock, feeding that tenancy equation. But now that that wave has come to pass, particularly on the capex side, which is the labour-intensive part of the wave that we've been through, we can see how that's affecting rental behaviour and vacancies. So this chart gives you annual rental growth for 3-bedroom houses, just to make it clean and simple. And the black line is the vacancy rate in the Hunter. And you can see fundamentally, rental growth is falling away. So now we're down to, if you take account for CPI, we're actually going slowly backwards in terms of rental growth. It's got quite soft. Following the strength that we had for quite a while there, you see the vacancy rate is creeping up. So it's not rocket science, it's a cyclical evolution. The investors have come in, provided the new stock, demand has fallen away, and now's the time to be a tenant in that part of the world because you've really got a bit more control over your ability to negotiate your rents, etc. And fundamentally, we're heading into a kind of period like this. Vacancy rates will step up to not a ridiculous level, but to a level that's a more balanced market, and the rents will level out for a while, and we'll have this kind of gap for a while whilst we find a new equilibrium that it carries on without all the contractors in the region, without that capex phase of resources been going on. We'll find this balance, but it's just going to take a while. So fundamentally, that means for me that what's the implication of that? It means that investment demand is going to be pretty soft in the short term. So we've had that wave, and we'll have a trickle coming through, going on, but it just won't be as strong as it has been over the past couple of years, fundamentally. So looking at what that means for housing construction and residential development, This is vacant lot sales, so again the columns are the actual number of sales and the black line is the median price of vacant lots. The first thing that strikes you out of that chart, for example, is just how flat vacant lots are in terms of the prices. They've got nowhere for about 8 years. Actually, always has about 0.1% per annum for the past 8 years. So if you bought a vacant lot hoping that that was going to be a good investment 8 years ago, unfortunately you've gone backwards from a CPI point of view. But from a market point of view, we can see that things are gradually improving. The problem that we had from the start of this was partly because the resources boom happened, so they obviously increased rates to try and keep a lid on other activity, and housing was one of them, and that killed off the housing market in October, November 03. The other side is the GST applied to new stock from the GST point, but it didn't apply to the established markets, so the new stock became relatively expensive. And we've been adjusting with those two things and the pre-boom that we had in housing for this period of time. But as you can see, from a volume point of view, it has slowly been improving over time. More to the point, quite recently, and I speak to my friends in this sector, things have been performing exceptionally well recently. I was a bit concerned about those two peaks in the columns that we have there in recent quarters, but I drilled the data and the providers of the data, Australian property monitors, and they sort of think that it's right, they believe it's right. But as soon as you expect the delays may be partly due to changes in stamp duty exemptions and so on, which just changed from being the established stock to new stock and those kind of gains, and people delaying to buy that kind of gain. But fundamentally, things have been really quite strong. I just think, given that investors are about to pull out of the market, it's that transition story again. So whilst we're going to have this hangover that's coming through from the pull-out of investors from the market to some extent relating to the resources cycle, at the other side they are looking to stimulate the housing recovery, and that will come up over time. But in the meantime, we're potentially going into a bit of a transition of a softer period, not a disastrous period, but a softer period before it picks up again. And likewise, as I say, first-time buyers will be, the conditions, they're not really negative, but they're not really exuberant in terms of their willingness to get into the market and drive activity as well. Look at the last one there in terms of residential building approvals, another leading indicator of where the market's going from a housing point of view. This is long-term staying. They've got boom time, end of boom back here, fall into the resources slump as interest rates are too high for the housing sector, going for a long while, GFC boost, and then, yeah, sure, it's showing a bit of signs of life. And the state is showing a bit of signs of life. That's mainly strata kind of accommodation coming on in Sydney. And we're just looking at housing here to try and get a cleaner feel, because even though this jumps around, it doesn't jump around as much as strata approvals do. And so we can see a bit of an upturn there, but it's hardly showing that housing is really ready to go and it's going to instantly come to the fore in terms of driving regional activity. I think it will over time, because they want to make it happen as part of the economic contribution to national growth and regional growth. But the evidence is that it's going to be a stop-start kind of difficult transition. So to summarise again, it's still a tightrope walk from the resources-based rock that we had over to these new drivers. Labour market's looking wobbly. It's going to, the data will be coming out, I think, that it's going to be weaker over the next 6 months. The resources context, the resources sector is bigger now, and we've been through the CapEx. What we've had is the CapEx phase come through. It's coming off, but it's coming off to a higher base. So production levels are ramping up. They're probably going to ramp up to under 200,000, the 190s or whatever they are, and that will change depending on what the consolidation behaviours are of the actual mines now, in terms of what's financially prudent for them to be producing right now. So the stimulus generally will be less on both sides. A bigger industry, but less stimulation out of each mine, if that makes sense. So that'll settle down in terms of the contribution from the resources sector. Other business investment, as I say, is a timing issue. As we go through things from tourism, the hangovers of this, the resources sector and the volume of activity that's really stimulating the region will be the short-term issue for us in various different ways. But we do have a lot of medium-term potential. The public investment is coming in there, is potentially there ready to go, which will create other private sector opportunities. The dollar, it has come down to an equation that's really going to be supportive of those industries who have been struggling in the face of it for a while now. Households have addressed their balance sheets, corporates have addressed their balance sheets. Michael might touch on this a little bit more. They've got cash to hand, they've just been really wary about spending it. They potentially have the capacity to spend, but will they and when is the issue. And likewise, interest rates are low and probably going to remain low for a while, and therefore that will stimulate activity over time, but it's really a question of when that comes to the fore within the region. Consumption, good example in terms of interest rates is in the balance. We've got forces against, forces for, and it would be good to get a bit more stimulation out of that sector. Housing to the rescue, it will do in time, but as I say, we've got that void that's been coming in terms of it's great for a tenant. In the short term, that'll take the heat out of the market as opposed to it ticking on. So on balance, I think this is where the difficult transition thing is coming through. So if I think of the critical ones that are illustration of that, is that the data that we're getting in terms of it being 26-year lows for things for businesses' current performance now in the current market. And yes, the medium term there's still a lot of optimistic, reasons to be optimistic there. But it's a question of how quick we can get there, how quick those forces come to bear in terms of driving the new drivers of economic growth, whilst the other ones wane. So I don't think we're going to have the kind of unemployment rates that we've had over the past 5 years, which got exceptionally tight for a while now. I think they're probably going to be lower and growth is going to be slightly more subdued, but we can get back to a reasonable economic position. The fundamental context that Mike might touch on a little bit more here is that we've gone through a huge resources boom. And as I say, usually we go through a huge boom, have a huge recession, and then we try and recover from there. The great thing about the resources cycle we've had is that because we've got a floating exchange rate, it's taken the heat out of the boom. And in terms of the other sectors, interest rate policy has taken out the heat out of the other sectors. So we come out of the boom now with the capacity to go and expand the other sectors and make the most of the situation. So that's really quite an optimistic thing. The challenge that I wanted to put there in terms of the region is that the resources being fell to our lap. I mean, it was our forte, it's what we did, it's what we knew how to do. We expanded and we've made the most of it, or made a lot of it. The challenge for us going forward is whatever is going to be growing, the growth going forward is not going to fall back into our natural situation. We're going to have to adapt, we're going to have to be more entrepreneurial, and we're really going to think about the opportunities in terms of risk-taking and innovation, so that we can, basically we're going to have to apply our minds to new opportunities to make sure we make the most of the opportunities that will come, because they're not going to readily fall into our natural strengths as they have done in the past. Thank you.